Hey, what's up, everybody? Welcome back to Investing Sucks, and today we're going to be talking about deep value investing again. Now, a few weeks ago, I made a video looking at some historical returns from different deep value investing strategies. So this video is going to be kind of building off of that because the main takeaway from that video was that the vast majority of deep value stocks that you end up investing in, if you follow these deep value investing strategies, don't actually end up performing very well. In fact, most of them actually end up doing quite bad. However, within all of the companies that do very bad, there is a select few that actually do extremely well when you follow these very specific investing styles. So from that, I got curious to see if there was any way that we could sort of differentiate between the ones that did well and the ones that didn't do so well. And essentially what I did was I generated lists of deep value stocks from 5 years ago and then also from 2 years ago. And I tried to understand at that time, so going back in time, why they were deep value stocks and if I likely would have bought them or would I have been scared away by whatever risk there was presented in that particular company. Because obviously there needs to be some sort of, identifiable risk, which makes it a deep value stock in the first place. Then once I did that, I would look at their returns over the next 5 and 2 years to see really if there were any patterns that I could pick up on that would lead to a deep value stock being a good investment versus it being a bad investment. So what traits do these companies have, right? Is there anything recognizable that we can look at for these companies that can help us identify them in advance, right? Is there any commonalities there? And what I learned after going through, I'd say about 50 different examples of these deep value companies, is without a doubt, there are some very recognizable indicators that you can look for that can lead to pretty decent returns, in my opinion. And there's also some indicators that can lead to companies that end up doing very badly. So in this video, I want to share those with you. Now, the way that I am defining deep value stocks is through Benjamin Graham's net method, which is where you calculate the net current asset value for a company, which is current assets minus all liabilities, so both current and non-current liabilities. And then that figure has to exceed the company's market cap. And the reason that I'm starting with net stocks is because of really just the natural margin of safety that they offer, right? Because in theory, the company is trading below its liquidation value. And liquidation value is kind of a worst case scenario way of valuing a company, right? Because even if the company were to go bankrupt, you would receive as a shareholder, an equity shareholder, the liquidation value. So if that amount is greater than the company's market cap, then in theory, even if the company went bankrupt, you would still actually be making money. Now, I did make the list a little bit more refined because what I noticed was there was quite a lot of industries that were appearing in these lists that shouldn't actually be there. They were just really there because of some unique feature to do with that industry. And a few examples of that is Biotechs for one. There was a lot of asset management companies in there, a lot of financial services companies, a lot of real estate related companies, and a lot of the times these companies weren't actually true deep value stocks. They were just in there because of some weird accounting technicality. For example, with the biotech companies, really, they would be included because they were just hemorrhaging cash every quarter. And the reason they're a net stock is because investors are already discounting the expected cash burn of that company going into next quarter, right? So because the company is, say, burning $20 million in cash every quarter, if the company is trading $20 million, below liquidation value, it's not actually true liquidation value. It just reflects what investors are expecting to see once the company finally reports their financial results. So that was one example of a company that appeared quite a lot. Another one was real estate companies. So specifically, this would be real estate development companies, which purchase land, develop the land, build on it, and then eventually go and sell it. So a lot of the times those companies were there just because 99% of their current assets would be inventory, which again would be things like land and properties. And if those actually lost value, then the net current asset value of the company has lost quite a lot of value. And then because they haven't reported their results yet, that hasn't been fully revealed to investors, but the investors can kind of infer that that's the case, that the company is, expected to lose a bit of value. So I just ran the script here. This is called Benjamin Graham Net Stocks Revised, and it's actually quite a short list. And we can see I also included their net income here so we can see some of these companies, a lot of them are losing money, some of them are actually currently profitable, which is interesting. So before I go any further into this, let me just remind you of the overall goal of this strategy, right? We're looking for that classic heads I win, tails I don't lose much kind of scenario, right? So it's a company that they can turn their business around, and if they are able to turn their business around, then you're looking at spectacular returns because the company is priced for the worst case scenario. So if anything except that happens, then they're going to be a great investment. But in the case that that worst case scenario ends up happening, you're still probably going to lose money, but you're not going to lose a lot, right? Because of the margin of safety. It's never going to be zero risk. There's always going to be some risk in investing. But that's the whole point of this strategy. So as I go throughout this video and I talk about the lessons that I learned looking at this strategy, try and just tie everything that I'm saying back into that end goal, right? Heads I win, tails I don't lose much, because everything that I say is going to be connected to that in some way. So before I go any further, I want to explain to you guys what my investigative process was for finding these 50 deep value stocks and then going back in time and analyzing all of them so that I can develop, this database of information on which of these companies end up doing well and which ones don't do so well. So the way I did it was to start, I used my website here, which is called tickernomics.com. If you're new to my channel, then this is a free website that I created to basically just help people get better at analyzing companies. And one of the key features on this is something that I've called scripting. And it's this new thing that essentially allows you to automate investing tasks. So it allows you to perform complex tasks in investing using code. And one of the applications of that would be creating a list of net stocks that met that criteria as of 5 years ago, while also excluding some of the industries that we talked about. So if you want to access these scripts for yourself, you can do that just by coming to the website. And then if you go to public scripts here, and you search for a script called net stocks 2 year backtest, and there's also one called the 5 year backtest. And then there's these other versions here called the revised versions, which remove those industries to make it a bit more specific. So to show you how this works, I'll just select the 2 year backtest one here, and then we can click run. And then this is going to go back in time 2 years and create a list of those companies. And then it's also going to show us what the returns were on an annualized basis over the last 2 years so we can see which ones actually ended up being successful or not. So we can see it's done running, and we can go to insight tables here. And here's our list right here. So it's actually quite a short list. There's only about 15 or 20 companies that make the list, and we can sort them by their returns, which is this column here. And we're going to see quite the variance in returns. For example, this company here, Core Scientific, lost 82%, and that's 82% each year, not just 82% total over 2 years. It's 82% each year. So that is obviously not a great investment. But on the other side, there is some companies that do quite well. For example, this one had 127% returns. This company, AirSale Corporation, had 53% annualized returns. And then we have a whole bunch of companies in the middle. So there's quite the variance in companies, right? But again, we saw this and we got interested to find out why some companies were doing so well and others weren't. And I looked at 50 examples of this, about 50, to get an understanding of that. So what we're looking at here is the questions that I would ask to understand this a bit better. So the first question I would ask myself, and by the way, this is an Excel file I put together. And if you want me to share this, then let me know in the comments and I can share this with you guys and you can look at it. But basically, we have the companies that I looked at here, and then we have a list of questions over here that I asked myself for all these companies. So number one, was it actually a net stock? So because we're dealing with very micro cap, small companies like 30 million, 50 million market caps, with smaller companies, there tends to be more data errors and inaccuracies, just because having perfect financial information on a website is difficult to do. So the first thing I do is I would cross-reference with a few other websites to make sure that the market cap and the financial info I'm looking at is actually accurate. And then once I would do that, I would ask myself, all right, is this actually a company that I can understand? Is it too complicated? Like, are they selling this, elaborate product portfolio of all these, high-tech products that I'm not going to be able to understand? Something like that, because at the end of the day, you only want to invest in companies you can actually understand. And then the next one was, does the company sell commoditized products? So we'll touch on this more later, but I did find there was a very unique difference between companies that sold commoditized products like oil, gold, things like that versus companies that didn't. So I'll talk more about that later. I would look at, what the makeup of the net current asset value was. So what are their actual current assets? Is it mostly cash? Is it mostly inventory? Did that make a difference in how the company's performed? The answer to that, in short, is not really, but there is a few interesting points about that, which I'll talk about later. And then the big question, which is why was it a net stock? And this one was overall pretty simple to answer. Really, what I would do is just take a quick look at the financial statements to see if there's anything that stood out, right? For example, is it clear that, their revenue just suddenly fell off a cliff? Like there was one example of a company that all the company did was basically they would purchase patents and then they would license those patents out. So, right, so they didn't have any, equipment or no physical operations. They would just purchase patents and then earn licensing fees on that. And this was 5 years ago. We are looking at this company, so around July of 2018. And the reason that they were a net stock was because 99% of the revenue was coming from one patent, which they lost the right to earn licensing revenue on. So the company basically, their entire revenue source just went completely dry. And at that point, the company's really was just a bank account with some cash and some investment. So that's kind of why it was a net because they just completely lost their revenue. So things like that, it can help you understand why it's a net stock. And I also use websites like Value Investors Club, which is something I've talked about a lot, to see if there's any write-ups on a company on that, which can help me shortcut my way to understanding why they were a net. Pretty much most of the time, if there's a company that goes up 20-30% in one year or down 20-30% in one year, chances are there is someone on Value Investors Club that made an article on that ahead of time, so it was a pretty good resource for that. And then this question, my next one, was a pretty difficult one to answer. So, would I have bought this one if I was looking at it 5 years ago? So, I tried to be as objective as I could in answering this, but it was difficult because you can always say with a company that, ended up having 30% returns every year for 5 years, you can look at that company and say, oh, yeah, I would have bought that one. But really, it's difficult to understand. So, I tried to do my best in assessing this, but the whole point was to try and understand what risk was presented to the company at the time, making it a deep value stock. And if that is a risk, I would have said, okay, I'm willing to accept that. Or if it's one where I would have said, no, I'm going to pass on this one. So that was an important step. Then the next one was what was the actual return on the company? And then what catalyzed those returns? So why did it end up going up? Why did it end up going down? There's always going to be a reason for a stock moving over long periods of time. So try to understand what ended up happening, right? And then from there you can understand what are the reasons behind companies that were deep value stocks. Why did they end up doing well? And then just what can we learn from this example? So that was my investigative process. Now let's actually dive into some of the lessons I learned. So the number one most important lesson that I got from this, and this is probably going to sound very obvious at first, but I promise I'll explain it further, and that is always ensure that there is sufficient margin of safety with every deep value investment. Pretty much every investment that I looked at that ended up being successful had sufficient margin of safety. So what do I mean by margin of safety, right? Well, remember going back to how we were describing this strategy, you're looking for liquidation value in excess of the company's market cap. So the more liquidation value exceeds the company's market cap, the more margin of safety there is. And from what I saw, whenever that amount was substantially high enough, that company a lot of the time ended up doing pretty well. Not all the time, but most of the time. So I'm going to use an example here. So there's this company which is called O2 Micro International. So probably not a company you guys have heard of. It's a rather small company. But over 5 years, this company had about 22-23% annualized returns. So obviously a very good investment overall. I think most people would be happy with earning those returns over a span of 5 years. So what was their margin of safety? Well, they had net current asset value of $54 million as of 5 years ago, and about two-thirds of that was liquid cash and short-term investments. So the company was highly liquid, very small amount of liabilities, and their market cap at the time was about $45 million. So you have close to $10 million of the amount that liquidation value exceeds market cap. For a $45 million company, that is a lot of margin of safety there. So that overall made the investment, more safe. And when you see something like that, you're kind of thinking, all right, well, how much cash is this company burning? Because if they're burning 10 million in cash every quarter, then that kind of explains it, right? And there's not actually a margin of safety there because the company in real times probably has a much lower amount of cash. So the easy way to check that is just go look at the company's income statement and then just look at how much money they're losing. So if we look at 2018, we can see in 2018, the company actually turned a slight profit, $2 million. In 2019, they lost $5 million. But remember, we had about $10 million in margin of safety, and they're not losing anywhere near that amount of money. So if you invest in this company now, you do get adequate downside protection. And if the business is able to turn around, you're going to get stellar returns, right? And if we look at, again, look at their stock price chart here, that's what ended up happening. It was around 2020, 2021 when the company really went up quite a lot. It went up about 10x in a short time period here. So what catalyzed the return? Well, for a quick background, what the company actually did was they sold integrated circuits to equipment manufacturers, primarily in the LED, LCD space. So they would think about things, like monitors, power tools. I have a few things listed here: mobile phones, low emission or zero emission vehicles, tablets, notebooks, that kind of thing. They were selling devices that were used in that. So what happened in 2020 that caused, demand for their services to go up quite a lot? Well, you can probably understand it had something to do with people being stuck at home around that time, and these things saw quite a lot of demand, and the business really took off. If we go back to the income statement, we can see um, what their profit ended up doing. It was about $12 million here in 2021. It's since come down quite a bit, and I believe the company is now merged with a different company, so I don't think you can buy them on the stock exchanges anymore. But you get the idea, right? And it is possible that you wouldn't have foreseen what ended up happening in 2020 and 2021 back in 2018 because no one could have foreseen what ended up happening. But the point is that doesn't matter because you had the margin of safety, you had downside protection. So, in the event that the business was able to turn around, whatever catalyst that may be, then you're in for stellar returns. That's really the heart of this investing strategy. And it all starts with having the sufficient margin of safety to begin with. Okay, so lesson number two is something that I ended up calling the golden triangle of deep value investing because it's three qualities that a deep value investment can have that, from my experience at least, looking at these companies, would mean usually that they're going to have pretty strong returns. And it's not guaranteed, right? It's never going to be guaranteed with this type of thing. But at least looking at it historically, most of the time these companies ended up doing quite well. So the first thing was they had to sell commoditized products, right? And the reason, again, commoditized products, things like gold, silver, oil, that kind of thing. But essentially, it has to be something that can fluctuate in price because if there is some external market force or some catalyst that happens in whatever market that they're operating in, then the demand for their goods and services skyrockets a lot and the business can turn around very fast. That was a common theme that I saw in a lot of the companies that ended up doing very well. Because again, we're looking for the scenario that's heads I win, tails I don't lose much. So if it ends up being heads I win, it's because there was some catalyst where this thing ended up happening. And to give an example of this, we're going to look at this company here, which again, it's a rather small company. It's called Friedman Industries. So this is a company that pretty much they sell steel. They sell these steel pipes. And you can see over the 5 years that they had pretty strong returns, over 20% compounded for those 5 years. So I would classify this company as selling commoditized products. And what we ended up seeing really with this company was once there was steel tariffs introduced in the United States, it made the demand for, locally made steel in the US go up quite a lot. So that was a huge catalyst for this company. And we can kind of see, when that happened, it was reflected around this time when the company went up quite a lot. So that was a big reason for that. The other one is something we've talked about before, which is a low cash burn rate. So again, if you want to understand what the cash burn rate is, just go to the income statement and look at what it's been over the past few years. So we can see here in 2018, they made $5 million. They lost $5 million the year after that. But even losing the $5 million is, it's not a huge deal, right? And then the other thing that was very important for these companies is they have to have maintained their asset base. So it can't be a company that sells commoditized products where they sold off a whole bunch of assets because then if you're assuming the business is going to turn around, they can't really turn around if they've sold off a lot of the assets that actually help them produce income in the first place. So they have to have maintained their asset base so that there's always that possibility in the future if some catalyst in whichever market they're operating in, if there's some catalyst that causes demand to go up and they can earn a lot of income from that, they need to be able to actually do it because they have the assets to continue functioning in their business. So the best way to understand that is for one, you would just look at what the assets have been over the past few years. And again, we're assuming we'd be looking at this company in 2018, so around here, $74 million in assets. And it's been pretty stable throughout the years preceding that. We can see, kind of in the $60 million range. So there wasn't a sudden change, right? It's not like the company just sold off all their equipment and, they're basically just a bank account now. So if the steel industry turns around, then they don't see any upside from that. So those are the three things, right? Low cash burn, maintain their asset base. So there's always the possibility that the business can turn around, and then they sell commoditized products. So again, the market prices fluctuate very rapidly and the business can turn around very suddenly. Okay, so lesson number three, and this is going to be a lesson on companies that you should avoid when doing this style of investing, and that is avoid companies that have a single shareholder that has majority control over the company, and also avoid companies with shady management teams, right? So this is something that can blow up an entire investment, and there's many reasons why you'd want to avoid these companies. And one caveat that I want to add to this is that I'm not saying that all companies that are like this are going to be bad investments. Remember, whenever I'm giving out these lessons, it's never just absolutes, right? It's just kind of general patterns that I noticed when I was looking at these types of companies so that you can understand on a balance of probabilities, if this is the case, then it's probably going to do bad or it's probably going to do good. And this type of thing, shady management teams or, just single controlling shareholders that kind of do weird things with a company, this is a very real thing that you're going to see when you're investing in these micro cap companies where management can actually actively screw over the shareholders of a company for their own personal gain. They can pay themselves very hefty salaries that they clearly don't deserve. There's many things that management can do. And when you're investing in these small companies, you have to understand that because when you're investing in larger companies like multi-billion dollar companies, it's not really as big a concern as when you're, digging through some of the dirt with these companies. So they're a good example of this, of a company that had a single controlling shareholder, is this company here, which is called Emerson Radio. All right, so clearly when we look at the stock chart for this company, it hasn't done so well. It's gone down quite a lot over the past 5 years. It did have this random rally here, which didn't really seem to make sense. I tried to understand why it was that the company just went up like super suddenly in this part here. And if I look at the charts, for example, one thing I noticed was if we look at the trading volume around that time, the trading volume increased substantially around that time, way above, what the historical average was, and then just kind of went back down. So I couldn't really find out why that was. So really, I just chose to ignore it because it seemed kind of weird. Overall, over the past 5 years, we've seen a clear downward trend with this company. And if we look at their financials, you can learn a lot about net stocks just by a quick peek at their financials. We look at the balance sheet, and we can go to a quarterly view here. And again, we go back to 2018, which is when we're assuming we were looking at these companies. The company was pretty much just a bank account, right? And now, that's not to say they didn't have, operations, they weren't earning income, but in terms of the balance sheet, it was a very small amount of liabilities, $4 million in liabilities, and then cash and cash equivalents here, we can see about 23 million. And then they had restricted cash equivalents here of another 23 million. So pretty much their entire current assets is just cash. So that was quite interesting. But remember, when we're dealing with this whole liquidation value thing, liquidation value only means something if the company actually liquidates. If there's another company that controls this company, they own the majority voting rights of this company, then there's nothing you can do because if they just decide to not liquidate the company, there's nothing you can do to, force that scenario. So that kind of explained why this company, even though it was perennially trading below its liquidation value, below pretty much the amount of cash it had on its balance sheet, subtracting out the liabilities, why it still ended up doing very bad. And also the business results, if we look at the income statement, were not great either. Pretty much the company just gradually lost money. And if you're wondering what this company does, they basically just sell things like refrigerators, microwaves, kind of like household electronics products like that in retail stores like Walmart, Target. So it's actually a pretty easy business to understand. And then if we just look at their revenue here, we can see 2015, 45 million, then 21 million, 15 million, 8 million. It just kind of kept going down and down. And the company has not done great. And it was strange to understand why that was. Personally, I think it's because if you look at the salaries that the management team was drawing, they're clearly just using this company as a way to pay themselves very high salaries that they don't deserve. So maybe that has something to do with it. But they were controlled by one company, and there were many attempts by various activist investors to try and, buy up a sizable portion of the company's shares and lobby to get management to pay out some of that cash in dividends and realize some of the value, but it just never worked out, and the company just kind of just didn't have great results. So that's one example of that. Now, the other example of this would be a company that has a very shady management team. So for this, there was this company that I found called Amira Nature Foods, and it's a very simple company. Basically, they just sell rice, and they're an Indian company that just sells rice. And I can't actually show you this company on Tickernomics because they've since been delisted. So the information that we get is pretty much going to be what's in here. And there was a massive margin of safety with this company. Their net current asset value was more than twice as big as their market cap looking at this company 5 years ago. So that stood out quite a lot. I was like, all right, and the company actually didn't end up performing very well. They pretty much went to zero. They lost 44% annually over the 5 years, and I'm pretty sure now they went to zero. But basically, the management team was just extremely shady. There was a lot of strange related party transactions that you were seeing where there were shell companies set up that was owned by the management of the company, and they actually ended up getting caught in a fraud where they took some loans that they had received from a bank and funneled it into some of those shell companies, basically defrauding the company. And once this news kind of broke and it came out, the company didn't end up publishing their financial statements or any financial filings. And to this day, they haven't actually published any financial statements since like 2019, I think. And the company basically just gradually went to zero. And to my knowledge, from my research, no one's actually heard of anything from this company since then. So who knows what ended up happening. And there's some really weird stuff going on when I looked up some write-ups about this company on Value Investors Club. So this is the company here, Amira Nature Foods, and this is one that was published a long time ago, so in 2012, which was actually recommending a buy position in this company. But then over the years, we start seeing some replies to these comments saying like conspiracy theory, raging short. Has anyone looked at this as a short? So I'm seeing this, I'm going, all right, what's going on? And there's some people in this website basically saying that some people were posting short ideas on Value Investors Club, but it was getting removed on the website. So that was the kind of thing where I'm just looking at it saying, all right, there's just so many weird things going on. And by the way, remember, we're assuming we're looking at this company in 2018. So a lot of this, the fraud didn't happen until after 2018. So it wasn't knowledge that you would have had at the time. But there were some very recognizable indicators that the company had, strange management, right? You could look at the related party transactions. You could see what other people were saying about the company here. I mean, all of this was posted before 2018 of people calling it a raging short. So there was clearly recognizable indicators. So what I would say to take away from this is if you have any doubts about management doing something weird when you're looking at a deep value stock, I would just say avoid it altogether. Just look for the companies that, have management that appears to be honest and there isn't anything weird going on there. Okay, now the last lesson that I want to mention on the topic of deep value investing is that to pretty much every rule or every lesson that I mentioned so far in this video, there's always going to be exceptions to that. And to prove that, there's one company that I looked at, which is this company called Vox International, that was basically an exception to every rule that I mentioned. So they did not have a very high margin of safety. In fact, their net current asset value 5 years ago was about 138 million and their market cap was 131 million. So not a whole lot of margin of safety there, but a small amount. They don't sell commoditized products. They sell products that are, mainly electronics products, various electronics products. that are very differentiated in the marketplace. So it's not like they're selling gold or oil or anything like that. The makeup of their net current assets was a split, whereas about half inventory, a quarter was in cash, and then a quarter was in accounts receivable. So it didn't really meet any of the patterns there. And it wasn't a company that had low cash burn. It actually had a fairly high cash burn. If we take a look at their income statement here, we can look at what it was over the past few years, and we can see like they're pretty much losing money every year. This company, negative 46 million, negative 41 million, going back a few years. So it was kind of strange when I looked at this company and I saw that the returns were pretty solid on this one. They had 18% annualized returns, and I couldn't really figure out why because it seemed to violate every rule that I just mentioned about, the margin of safety, the cash burn, and then if we look at, for example, let's look at a valuation metric. So their price to sales ratio, we can see pretty much the reason for their returns being pretty decent over the past 5 years is just their valuation multiple has expanded a little bit. It went from here to where it's about zero point 0.3, and it expanded up pretty much double where it got to about zero point 0.6 in this range here. And then it had a much higher run here where it got to almost a 1 price to sales ratio. And I couldn't really figure out why. It really just seemed like it was renewed optimism in this company for whatever reason, but it kind of violated every rule. So as I've, talked about all these rules, I have found that a lot of them are general rules, but they're never going to be without exceptions. So the key takeaway from this video, I'd say, is again, when it comes to deep value investing, you're looking for the classic heads I win, tails I don't lose much scenario. And the companies can be found in that scenario in many different ways. And in the future, I'm probably going to make a video discussing an actual deep value investment that I make. So stay tuned for that because I do, now that I've studied this strategy, I do want to actually implement it and try to, have success doing it. And also make sure, if you haven't already, make sure you check out my previous video where I was actually diving into the historical results on deep value investing. So with that, I want to thank you for listening, and I'll see you guys in the next video.